Welcome back to Morning Trade Live. Let's talk inflation as we've got an update coming to us on Friday. Same day, of course, that Jay Powell's got a little speech as well. Ben Breitholtz joins us again from Arbor Data Science. He's the data scientist there. All right, Ben, welcome back. Give me your 60-second take here firstly before we get into the charts. What should Jay Powell say and what will he say?
Yeah, so this morning is, we woke up to kind of a chorus.
I put you on the spot.
Yeah, that's fine. we woke up this morning to kind of a chorus of non-voting members calling for the taper to get going, and Bullard even used those terms. We had George and Kaplan come out with some similar messages, and they believe that we need to essentially rein in the stimulus due to this persistence of inflation, and they're kind of even shucking aside delta risks. Now, this isn't coming from the top three core members. You got to remember, you got to focus on Clarida, Brainerd, and Powell, and the three of them remain quite committed to this patient language they've been using and the transitory, kind of explanation for inflation. They want more employment reports. They want to see inflation. They want to see if Delta peaks and so on. So I think Powell will give some kind of loose announcement, but not a formal announcement. The taper is coming, and I think that is the right move. There's still plenty of risks, and like my colleague Jim Bianco has been saying, and I have been repeating, is that there will be plenty of off-ramps that they will have along the way and that they will give in order to potentially slow or delay that taper as we move into 2022.
So will Powell take the delta out and push to next year?
I think that there's a good chance that he at least waits for us to see the August and September employment reports as well as continued inflation. You got to remember that core inflation is just finally beginning to peak. We saw a pullback below 4.5% on a year-over-year basis for core CPI, and then we've started to see some of these supply chain induced issues begin to abate. So supplier delivery times, Manheim auto prices, a whole host of measures have all seemingly begun to peak between May and July, but you can't exactly say that after we've seen only 1 or 2 months of pullback. So I think we need to see whether or not that persists. If so, then maybe we have the opportunity to see core inflation kind of start to retreat. Now, in the back end of that, of course, is this whole transition we've been talking about from all these idiosyncratic forces to shelter inflation. That's such a huge portion of core inflation. And how that develops into year end is going to be the critical component of this inflation story.
Okay. All right, let's get into it here, Ben. You've got a lot of good charts for us. Looking at, firstly, just the seasonality of both inflation and bonds. I didn't realize this was a thing. So what's the inflation seasonality?
So inflation has this is on multiple aspects. So if you look at it, from an energy perspective, we look at it from the actual core and headline CPI releases. This is globally and domestically. Inflation releases tend to peak in August and then roll off and decline. Same thing goes for TIPS flows. So if you look at the TIPS ETF and the flows that come in and out of them, they habitually also peak in August. So we have this seasonal factor that typically leads to slower run inflation and typically is a kind of a headwind to TIPS break-evens and inflation expectations running towards year end. So all of this is happening at quite a critical juncture where we're all hyper focused on inflation, and we have all these idiosyncratic forces that are rolling off. We have seasonality that favors tempering inflation, but like I said, on the other side, we have shelter inflation that is now brewing on a 3-month annualized basis. OER is running at about 3.7% year over year, and that will continue to accelerate. And if you look at Apartment List and Zillow and other sources of private rents, they suggest that shelter inflation should rise towards 6 to 7%, which could add 1.5 to 2% to core inflation. So we're in this murky period of confusion that I think leads to further range trading, and then ultimately inflation becomes a major story towards year end as we get the shelter component to really rear its head.
All right, so is that last component is kind of the key. I want to get to that, but there's a few other steps along the way. You've got a great chart, I think, that culminates this conversation with the housing situation. But just to look at also the seasonality for the yields too. I mean, it seems like we went kind of through some of this bullish yield seasonality period, and it wasn't really that bullish the last couple months. So what happened? I mean, do we make that ground up, or was that our bull run for yield?
Right. I mean, that's the question. Now, seasonality is, it's seasonals. Of course, it's not going to take into account all the major factors that are going on geopolitically and, of course, monetary policy and fiscal policy. But, historically, we're at the point where real yields as well as nominal yields tend to bottom. Now, the thing that I'm most interested in watching is the real yield component. So with 10-year real yields all the way down to 2-year real yields so dastardly low, any kind of rise in them, which would come most likely with the taper and some more uncertainty coming out of the Federal Reserve, that is a big issue for investors because that would also lead to potentially a higher dollar. And what is the double whammy for risk assets and for the stock market in general is a tandem rise in real yields and in the U.S. dollar. Historically, that's been a poor period for risk assets, and really it's kind of a sea of red for most markets. So that's something to really keep an eye on as we head into year end. And that pressure, like you said, with the seasonality is starting to be there. And I think with the taper talk and how quickly that develops, that could help fuel higher real yields finally, and ultimately the U.S. dollar as well.
Okay. Ben, when you look at the potential for shelter, your point is that ultimately at this juncture, that's what's going to determine how sticky inflation is or how much potential it has to rise. Walk me through this chart where you've got CPI forecasts in 3 different versions of it based on how housing goes. What is this looking at? Because there's 3 very different outcomes here.
Right. So what we wanted to do is we wanted to say, let's allow all of the other factors away from shelter inflation to revert back to their means. And that means this idiosyncratic forces will abate and do so over the next year, 1 to 2 years. Now, the key thing is, does shelter inflation track private rents? And we've done a lot of modifications to private rents to make them equal to how the BLS calculates OER. And if we allow them to move 1 for 1 with Apartment List and Zillow, we could see core inflation above 6% if that happens by early 2022. Now, that's kind of the big upside. If they run at about 50% the pace of private rents, that means OER, as the BLS calculates, we could still see core inflation above 5% into early 2022. But the critical thing here is, where does core inflation reside into 2023? Is the glide path for core CPI to 2.5%, which is well above economists' expectations. Economists are expecting somewhere around 2.2 to 2.3% for headline, meaning they believe that we'll have sub 2% core inflation into 2023. And if we see that regime shift higher in sticky and core prices, that would indeed be the first time this has happened since the 1980s post a recession or a global slowdown. And that is somewhat of a game changer, even though it's fine, yes, just a mere number of tenths of a percentage point. But that is something that is a shift, and that is something that could reverberate through markets. And
your view right now is that we are going to get housing to keep getting more expensive when we look at just the trend across states and regions, right?
Yes, yeah, we've burrowed into a whole host of data, in particular search activity across the 23 big metros that the BLS covers, and we have seen a little bit of slowdown in the apartment rental market, but nothing that is kind of a problem for the growth rate to continue. And I think that if you do watch these private rents, yes, we're not BLS OER the way it's calculated, how slow it is and smooth. It's not going to track it 1 for 1, but we are going to see a continued rise in shelter inflation. And we got to remember, that's 25 to 30% of core and or headline CPI. And that's a much bigger weight than a lot of these idiosyncratic forces that we've seen, anything, from kind of airlines to hotels to used car rentals. And that's going to have a substantial kind of, floor that's going to be put in for core CPI. So now, on the flip side, investors are really confused about whether or not this eventuality is going to happen. A rise in core inflation, a regime shift higher. Right. They've been essentially sideways since the beginning of the year if you look at inflation swaps. So there's still a lot of confusion about how this will all go down.
One of the ways that shows up, I think that's a pretty compelling and fascinating chart, is one that looks at inflation-friendly funds. So commodities, you've got energy, industrials, materials sectors. real estate outside of REITs, and then the inflation-protected securities TIPS. So those are the different colors we're looking at. The pink is for TIPS, blue commodities, green real estate, light blue materials, industrials, orange, energy, yellow. And what we're looking at here is the fact that pretty much all of these things have started to turn lower, except maybe TIPS to some degree, but those have faded a little bit, or what do you see here?
Yes, yeah. So the TIPS are kind of an oddity, and I'll talk about that in a second. But yes, so in energy, industrials, materials, and even commodities have started to kind of come off the boil. And this is a pretty big sea change since Biden was elected in November. We've begun to see some shakiness about the endurance of this inflation story. And TIPS you have to always look at in relation to treasuries. So if you look at them in terms of their actual flows into medium to long-term treasuries relative to medium to long-term TIPS, that momentum for TIPS is actually peaked. So we've seen just good old nominal treasuries begin to catch some wind, while as TIPS have not kept the same pace. And that's kind of another indication of peak inflation expectations. Now, that doesn't really jive with what I'm talking about, a stair-step higher in core inflation, and ultimately, shelter inflation becoming somewhat of a problem. So I think that will come to ruse, and that will keep inflation expectations elevated. It's just that investors are still kind of caught in the middle between this transition and quite confused. So if you were trading these instruments, I would expect further range trading until the inflation story becomes clearer into year end.
Okay, because right now it seems that the story has been about the supply chain driven inflation that has ebbed and perhaps led to some of these lower commodities, but there's also been growth concerns in the background too. So the next step, it seems, is watching what happens with housing, with rents in particular. And right now the bias, according to your data, would be that we expect that to warm up a little bit. But Ben, really like always helping us connect the dots. Very helpful to know what to look for. Thanks a lot, Mr. Breitholtz.
Thank you, Oliver.
Sure thing. And thanks for the thoughts, too, on the Fed tomorrow. Ben's a data scientist at Arbor Data Science.